welcome back to Prosperity Playbook. We are a group of friends that realized most of the important lessons we learned in our life didn't come from school. So we decided to put this podcast together to share those with you. So today we're going to be talking about life insurance. That may not be our sexiest topic ever, but I can promise you it's probably one of the most important ones that we'll cover. As we've said before, it's one of the things I recommend anytime somebody is buying a home. It's the most important thing that you should do right after that. So we're going to kind of focus on Britt here since she's our resident insurance agent today. And I'll just kick it over to you, Britt.
Sweet. Well, you said life insurance isn't sexy, but I thought it was pretty sexy when Forrest bought life insurance. So I was like, oh, he cares. I think the biggest question that I get asked when people are asking about life insurance is, how much do I need? I have no idea how much I need. People will just kind of throw out random numbers and think that's enough. Or a lot of people have a life insurance policy through work. Oftentimes that might be $10,000, $20,000, $50,000, and people assume that that's enough. And
well, let's take a step back from that and go to, does everybody need life insurance?
I would say if you plan on dying at any time in your life, that
okay.
Yeah, absolutely. The amount of life insurance that you need absolutely differs, but I would say that everybody does need life insurance for sure.
What do you usually use life insurance for?
Well, I think most importantly, you're providing a safety net for the people who you love the most. Life insurance can be used for a lot of different ways. You can use it to protect your business if you have a business partner and you want business continuity, which we talked a little bit about in our last episodes. But primarily, it is to protect the people that you love, to protect them, give them the ability to stay in their house, give them the ability to potentially send your kids to college, give them the ability to pay off debts and still have income replacement when you're no longer here.
So on the very most basic level, you buy a policy, and when you pass away, an insurance company cuts a check to your family, correct? Or whoever your beneficiary is?
Yep, absolutely.
As long as you didn't murder them?
Correct. There are a couple of clauses in life insurance policies. A little trigger warning for suicide here. There is a suicide clause where within the first 2 years of most life insurance policies, if you commit suicide, it won't pay out. And if you are listed as the beneficiary and you murder the person that the policy is on, you also will not receive the payout. Yep.
What if you die jumping out of a plane?
It depends on what type of policy you have. There are a lot of exclusions. There is an aviation exclusion for a lot of pilots. There is an exclusion for risky activities on some policies like rock climbing or skydiving or things like that, but it's not on every single policy, so it would just be important to make sure you know which kind of policy you're purchasing.
Interesting. Okay.
Yeah. All right.
So are there times in your life you need to figure out what your amounts are? I'm assuming this changes over time, right?
Absolutely. The obvious, most kind of exponential reason to buy a policy is when you buy a home. Of course, that's most likely the largest liability that most people are going to take on. So that is when I typically start the conversation with people, is when they buy their first home. But anytime that you have a child, that is another really important time to look at the policy. And when you're approaching retirement age, that's also a really important time to look at the policy. But throughout our lives, we have so many things that change, right? We are going to typically in our younger years have a lot more liabilities than we will in our later years. We have credit card debt, maybe we're buying cars, we have student loans, we've got our mortgage. And then as you approach retirement age, those things are going to change. So post-retirement risks can be loss of Social Security income, increasing healthcare costs. As we get older, typically we have more health issues that are arising. Maybe you have a decreased stock portfolio because the stock market is pretty risky, and so there can be potential for lost income there. And then if you think, you've had your home for the last 30 years, now it comes time where you're needing to replace your water heater. Maybe you have to replace your roof. And so there's a lot of those financial risks that come on. And these are all things that fluctuate so much throughout our lives. So the way that we look at it is typically prior to retirement, your needs are a lot higher when it comes to insurance, because if you were to pass away tomorrow, the amount of debts that need to be paid off are going to be significantly higher than they will once you are past retirement. But that doesn't mean that all of those risks just go away. And I think that's the mistake that a lot of people make, is they'll buy a term life policy for their mortgage, but they don't think about what happens after the mortgage is paid off. It's not like all of your debts just go away and disappear magically.
Right. There's still expenses to live off of every month.
Exactly.
My stepfather just passed away, and he left my mom life insurance policy that started off much higher when he was younger and then dwindled in value. Do you know what kind that was?
That was most likely a universal life insurance policy. We'll talk about it a little bit later, but there are a few different types of policies to kind of balance your portfolio, and a universal policy is the most flexible because you can kind of decide what your goals are with that policy and then can tailor it throughout the life of the policy so it can grow, it can shrink, your payments can be higher, they can be lower. Whereas with most other life insurance policies, once you get it set, it's kind of locked in stone and you can't make any of those changes.
So if you're like a single person, you don't have any kids, do you need life insurance? And if so, what for and who are you paying out?
I would say if you don't have any liabilities and you don't have any assets, you don't have anything that you really need to protect, you do still want to make sure that your family has enough to pay for your funeral.
Got it.
Typically, in the state of Montana right now, to be cremated, it's about $10,000. And to have a funeral, it's about $25,000.
Wow.
Can you do it cheaper than that? Of course you can. But, to have a nice funeral and nice flowers and whatever pictures you want, it's costing about $25,000.
We were just talking about that earlier today. And I feel like when I was younger, I thought funerals are silly. Like if something happens to me, I don't want a funeral, just like, whatever. But throughout my life, when I've been to a lot of funerals and had some really tragic deaths in my life, I've come to realize how important that is for the people that are left behind. And it's a grieving process. And I've just come to really think that that's way more important. So I think you're right. I think probably everybody needs at least some form of coverage.
The amount of people in my life that didn't have life insurance and have either passed away or had somebody in their family pass away, and they're out posting GoFundMes and trying to raise money in other ways for the funeral costs and the end of life costs, is crazy when it's, you could be paying $8 a month to have a policy to cover all of that, which is, literally pocket change when you look at the grand scheme of things.
Yeah, it's a coffee.
Yeah, exactly. There was a gentleman a couple weeks ago that I asked if he preferred burial or cremation, and he said, "Oh, just put me on my horse and slap its butt." I was like, "Oh,
Heard that
okay."
too. It's Montana way.
Not for me, but
No.
to each their own.
The logistics of that are a lot more awkward than you think.
Yeah.
All right. So let's dive in a little bit deeper on that. So now we've addressed if you're a single person, you at least need your end of life care. So then probably the next step in that is when you're in a serious relationship or you get married or you have someone else that maybe you're cohabitating with. Is that the next step when you probably need to increase that?
Absolutely. I would say anytime that your liabilities or debts significantly increase or decrease, or anytime that you are going into life with another person, be it a partner or a child, or if you are a caregiver, anything like that, it's definitely really important to look at those numbers.
Is there a calculator online somewhere where you can have that conversation with somebody and plug in different numbers?
And I'll kind of go into that actually. So we do what's called a life needs assessment. I guarantee if you type that in online, there are probably a bunch of different calculators. I know at State Farm when I worked there years ago, they had one of their own. But basically what you can do is down the side of a piece of paper, write the letters LIFE. And next to each of those, you're going to write down some numbers. So L stands for loans or liabilities, debts. Okay, so you're going to write down your mortgage amount, any student loans, car loans, credit card debt, business loans, any outstanding loans, debts, liabilities that you personally have. Go ahead and write next to the L. Then you're going to go down to I, which stands for income replacement. So if all of the debts that you just wrote down under L were paid off, would you be able to comfortably pay your expenses? If not, what's the deficit? that is the income replacement amount that you're going to want. And now we will typically multiply that by about 5 because you won't want your partner to just have income replacement for 1 year. You'll want them to have at least a few years to kind of figure things out.
That makes sense.
It's also important in that to note, if you have young kids, if you have kids that aren't in school yet, how much do you think their preschool is going to cost before they're in kindergarten? Because that can be a significant cost. So that's typically where we will factor that in as well.
AK daycare.
Yeah, exactly. Then when we go to F, that's for final expenses, which is the cremation and burial costs that we just talked about. So calculate in $10,000 to $25,000 there, depending on how you prefer to exit the world. And then E is for education and extras. Education, we're talking about college tuition for kiddos, or just giving them the choice. If you were no longer around to support them and help them make that decision, would you want to give them the financial freedom to be able to choose? And we'll typically average that around $100,000 per child. And this is where maybe you're talking to somebody that doesn't have kids yet. Maybe they just got married and you ask them this question and they're like, well, yeah, that sounds great, but I don't know how many kids I'm going to have. I don't even know if that's going to happen. In those scenarios, I'll typically add a little bit of extra cushion on the policy, but then I would say down the road when they do start having kids, it's time for them to revisit and potentially get another policy.
So that's a good point, I think, to bring up is like, this isn't a one and done. Like I bought life insurance and now I've got what I need. This is something that you continually revisit and that amount that you need will grow or decrease then.
Yeah, it is important to note that your life insurance policy, the price of it is cheaper the younger that you are. With every birthday that you have, the policy is going to be more expensive to buy. But once you buy the policy, that cost is locked in. So it is better to purchase them when you're younger. But like I just said, we don't always know what our needs are going to be.
Sure.
So there are a couple of different ways to go about that. A universal life policy is something that I definitely recommend, even just getting a small one when you're young, because it's a whole life policy, which basically means it lasts your whole life. It accumulates cash value, which means that once you have put enough money into that policy, you can borrow against the cash value at a later date. So not only does it have the death benefit that will pay out, but it has this cash value that you can borrow against and use if you need to. I had a universal life policy that my parents set up for me when I was a baby, and I was able to pay my first year tuition with most of that money.
That's cool.
Yeah, it was super cool.
I saw my stepdad had used his to pay off my mom's car.
Awesome. Yeah. I mean, it's nice to have that, especially if you don't have other investments. If you don't have a broad portfolio, it can be great. And the death benefit doesn't go away as long as you have funded that policy with enough money. And with the universal life policies, you can increase or decrease the death benefit throughout the life of the policy. So maybe when you first purchase it, you're like, I don't know, give me $20,000. And then you get married and have a couple of kids and clearly need significantly more life insurance. You can typically increase those policies in small increments. Like my policy, I can increase by $10,000 every year. So at that point in time, you could increase it continuously throughout the years, depending on what your policy looks like, and could also purchase a term life policy to help fill the gap.
Yeah, I saw hers had decreased all the way down to $100,000, and he should have probably increased it because that's about what we live off a year.
Mm-hmm.
So do you then have to re-qualify health-wise if you're increasing that?
No, that's the really nice benefit with plans like that is that once you get the policy written, then you don't have to provide proof of insurability at any point in time.
That's nice. That was a good question.
Yeah, there's another way that works with term life policies. A lot of term life policies are convertible. What that means is that at any point, well, I guess I shouldn't say at any point. It depends on the policy you have. Some of them, it's within the first 5 years. Some of them, it's through the whole life of the term. But you can convert either the entire policy or a portion of the policy to a whole life policy. So for a lot of people, let's say you're 22, you're just out of college, you just got married, and you're purchasing your first life insurance policy. You don't have very much extra money lying around. So it only makes sense to purchase a term life policy. It's cheap. It gives you enough coverage, but you know that eventually you want whole life coverage. So then you get 10 years down the road, you have a meeting with your insurance agent and you say, hey, I really want whole life. What does that look like? Well, you can convert either the entire policy or just a a portion of the policy to whole life at that time, you don't have to provide proof of insurability. So there's no underwriting at that time, but what is converted is going to be rated based on your age at the time that you convert it. So it's not going to be rated based on the time you initially wrote the term policy. So it will be a bit more expensive.
Let's talk about what it looks like in the beginning. So what kind of health questions do you have? Is this like, are you doing blood tests? Are you doing a full doctor workup? Tell us about that.
Great question. It depends on typically the type of policy and your health in general. There are some policies that don't require any underwriting, but they're typically going to be more expensive. For example, Ethos Life, you can basically just answer some questions online. It's going to ask you a little bit about your health history, if you have any current health issues, if you have diabetes, and then it will give you a rate based on that. But you don't have to go do any physical underwriting, so the policy is going to be a bit more expensive. But some people don't care about that. They just really like the ease of being able to get a policy in place right away. For most policies, there's going to be kind of a series of underwriting. The first step is you answer an underwriting questionnaire. They're going to ask you about your health history, if you're taking any current medications, if you have high blood pressure, if you have diabetes, if you have any sort of diagnosed illness, whether that is a mental or physical illness. And then depending on where you fall on their spectrum after answering those questions, they will either give you an instant quote and you can just bind the policy, or they will ask you to go get a physical exam where you typically have to do blood and urine samples. It's paid for by the life insurance company. You don't have to charge it to your insurance or anything. And then once they run your test results, then they will give you your quote or say that your coverage has been denied. The insurance policies run on a scale where it's going to be traditional, standard, tobacco, or non-tobacco, which is another good point. If you use tobacco, life insurance is way more expensive.
Is that currently using, or have you ever used, or is there a time frame?
Both. Most of them you have to have been clean for at least a year in order to be considered non-tobacco.
Got it.
Some it's up to 5 years too, but typically a year clean. You will be rated at a standard rate usually, even if maybe you just smoke cigars when you go to weddings or something like that. Typically that will still affect your health class rating. So there's standard, tobacco, and non-tobacco, and then there's usually a premium rating, and then there's usually a super premium rating above that. So it just depends on how healthy you are and what your health history looks like.
And that includes vaping.
Correct, yep.
Mm-hmm. Okay, so that's a good clarification. What about like the nicotine pouches like Zins and Rogues and that kind of thing that are technically non-tobacco?
Some policies count them, some policies don't count them. So that is a good point when you're talking to your agent to let them know what specific type of tobacco you use, because that will determine which carriers they need to quote with.
Interesting.
Yeah.
Awesome. All right. Well, let's go back to where we were talking before. You were explaining universal policies. Are there other types of policies that we should be considering as well?
Yeah. I'm just going to start with the basics and then kind of go through and explain each one.
Perfect.
The most basic type of life insurance is going to be term life. Term life is like renting, where at the end of the term, you are no longer... Go ahead. I know, I wrapped it under so it wasn't getting stuck.
I'm good.
Do you want to wrap it back down?
No, it's fine.
It's okay.
I just pulled it a little bit more, so I had some slack.
Okay, perfect.
I was like, oh God, my leg's going with it. Sorry.
I saw your eyes get red.
It's like, uh-oh.
Okay, so there's term life insurance, which is like renting, where at the end of the term, you don't get anything back out of the policy, okay? So you have been paying into it month after month, and the big benefit is that if you pass away at any point during the term, your death benefit will be paid out to your beneficiaries. These typically run on a 10, 20, or 30-year term. I recommend oftentimes to people, if they get a mortgage, to match their mortgage length with their term insurance. But that being said, a 20-year term is the most cost effective. So it might be more beneficial to do a 20-year term and then just get a little bit more whole life insurance, which we'll talk about in a second. Your rate is locked in with a term policy. Like we talked about a second ago, you can typically convert some of that policy to a whole life policy If you don't, at the end of the term, your rate will drastically increase, and then it will increase every single year if you decide to keep that policy in place. I don't typically recommend this unless somebody doesn't have another alternative. Maybe they were diagnosed with a terminal illness or something and can't get another life insurance policy. That's the only time that I would recommend keeping it. The next type of policy is still a term policy, but it's called a return of premium. It is exactly the same where it's rent to own, where it's like renting, but this is more like renting to own, where at the end of the term, all of the premiums that you paid into that policy, you're going to get back. So the policy is typically about twice the cost of a traditional term insurance policy. So you are paying more each month for it, knowing that at the end of that 20-year term, or, whatever your term is, that money is coming back to you. So, in my mind, it makes more sense to put that money into a high interest savings account or something like that. But for people who maybe are trying to expand their portfolio, they already have money being put into those different places. That can be a really good way to, get a little bit of money at the end of your term. If you cancel your policy, you don't get any of your premiums back.
No, if you died after 1 year of paying into it.
It's either the death benefit or the premiums. So if you die, you don't get the premiums back. You just get the death benefit.
And how do they decide?
What do you mean?
Because if you survive throughout the entire term,
Yeah.
that's when you get the premiums back.
Right.
But if you die during any time of the
You get the
term,
death
you get the
benefit.
death benefit only.
Okay.
Yeah.
Got it.
The next type of policy that's available is a whole life policy. This lasts your whole life. A whole life policy is like buying a house. Okay, you accumulate cash value throughout that policy. Basically, every time you make a premium payment, some of that money goes to the insurance company just, to help them run, and some of that money goes into your cash accumulation for the policy. At the time that you're done paying your premium, typically your cash value should equal or be close to whatever your death benefit is. Your cash value in these policies grows tax deferred, and they're typically about 3 times or 4 times the cost of a traditional term insurance policy. I typically recommend for people to have their policy fully funded prior to being on a fixed income. So basically, you can do a limited pay option where you're paying on the policy to age 65, or maybe if you have some more expendable income, we'll do a 10 pay option, which means that you make 10 equal payments and that fully funds the policy. But that way, once you're on your fixed income, you're not having to worry about making premium payments, but you know that your life insurance will cover you for the rest of your life still.
And I would assume that inflation plays a role in that as well. If you are buying that when you're super young and you're fully funding it, you want to consider what that's going to actually be worth for you down the road.
Absolutely. It is important to note that whole life insurance policies aren't tied to the stock market. So the cash value that's in them is guaranteed. So basically, when you get your quote, they're going to show you what your cash value is going to look like. It can be more than that, but it will never be less than that. So it's not going to fluctuate like a lot of your other investments will, but it will. It does have the opportunity to get bigger and bigger.
Now, some people do use their life insurance as investment, correct? Their cash value
Absolutely.
life insurance?
Yep.
All right. And when would that be potentially a good investment vehicle for someone?
It really depends on what the rest of your portfolio looks like. And I can't speak too much to that, not being a financial advisor. Definitely talk to your financial advisor about that. But I typically recommend it to people when life insurance is very important in the first place, and term life insurance isn't going to cover you for your whole life. So just making sure that you have a whole life policy in place is really important to protect you for your whole life. So if we're going to have this policy anyways, we might as well make it work for you. Oftentimes I will talk to young parents about getting whole life policies in place for their kids, especially universal life policies. You're going to be paying maybe just dollars on those policies every month, and then your kids can use that cash value to help them pay for college, and then they get to take ownership of that life insurance policy, continue to pay on it once they're 18, and then they already have a life insurance policy for their whole life as well.
I think that's an important topic because I don't think a lot of people think about getting life insurance for their kids because there's no income or debts or anything like that. But one of the emotional things for me is if something happened to my child, like I'm not going to function for a while. I'm going to need, having a little cash cushion there to be able to like get me through, and like you said, long term or their final expenses and that kind of thing too. But it's a cheap thing to do for peace of mind, right?
Of course. And like you said, it's cheap. It's literally dollars, and it's giving you so much peace of mind. And then it's a really cool gift that you get to give them once they are graduating.
I still remember my sister and I were traveling in New Zealand, and we decided to go skydiving, and we called my parents after we landed back on the ground and said, "Hey, guess what we just did?" And my dad's first comment was, "Oh, I wish you would have told me before. I would have increased the life insurance."
My mom let me know that she has one on me she's had for a while. And I think it must be a whole life because it's gone up in value very slowly. But it was just a small policy.
Yeah.
Well, I have seen people do it as an investment. Back to that piece of it, like super funding their whole life policies, because there are some tax advantages to how that money grows in there, right?
Yeah, it grows tax deferred.
So then I've seen people then borrow that money back from there, which you're not paying on taxes as well. So it's a whole higher topic for your financial advisor, but just something to consider.
It is important to note, I think we discussed it last time, but you can take life insurance policies out on other people, but if you kill that person, you won't get the money.
Yeah, we did talk about
that at the very beginning.
No murder in the house.
That was my question.
With universal life policies, they are a form of whole life policies, but they're very customizable. You can increase the death benefit, decrease the death benefit. You can also increase your premium payments or stop paying it altogether. As long as there's enough money funding the account, that policy will stay in place. So as you're making those changes, it's really important to talk to your insurance agent so that the policy doesn't cancel due to lack of funding. But maybe you reach a point in your life where you just really don't have the money to make those payments. You are able to make some changes to those policies at that time, which is really cool to not be able to pay on that and still keep the policy in place.
But term you can't, right?
Correct.
If term stops, then policy lapses.
Yep, exactly.
Okay.
Yeah.
So just to clarify on that, so you're saying that you've had a whole life policy that you're building some value in, and then if you stop paying that, it kind of starts to eat itself, like it pays its own premium.
Yep, exactly. And universal life, a traditional whole life policy doesn't work that way. But yeah, a universal life, it can dwindle away to nothing. If you don't pay on it and it eats away its whole cash value, of course the policy is going to cancel.
Got it. That makes sense.
Yeah. The way that we typically talk to people about how to balance out what the heck type of policy do I get? What do I need? We recommend that people lock in a whole or universal life policy prior to age 40 or at the very latest by the time you're 50 because of the cost. Once you surpass age 50, whole life policy gets crazy expensive. So even if you just get a $50,000 whole life policy so that you know that your end of life expenses are covered, you know that you're probably going to have some other avenues where people can pull money from at that time anyways, but lock in whole life before you're 40 if you can. Term life, you can always purchase a short term. You can purchase, they basically call them like end of life policies that are $15,000. You can purchase those at any point in time, even when you're, in your 60s, 70s. So I just think it's really important to know, get your whole life locked in before you're 40 if you can.
What about long-term care? Not to sidetrack, but just wondered if y'all do that.
Yes, long-term care insurance is a little bit different. So I do recommend having both life insurance and long-term care. Long-term care is crazy expensive, and the insurance to cover it is also crazy expensive. But you get to pay on that for many years stretched out between monthly premium payments instead of all of a sudden getting hit with $10,000 a month or whatever. I don't even know how much it costs these days.
You're spot on.
It's
between $6,000 and $10,000 a month.
Crazy.
Yeah.
And I do feel like with that, for me, we have a long-term care insurance policy, and it was peace of mind for me. I knew it was expensive, but I thought, I've got a daughter who's an only child. The whole burden's going to fall on her. There's no siblings. There's nobody else. And so for me, having a long-term care policy was just, Lexi doesn't have to deal with me.
Yeah.
Like,
well, I think life
there's a
insurance is
trick to
the
it, too.
exact same way.
Agreed.
Yeah.
there's a trick to it too. So when you're getting the payouts for your long-term care, you can actually have the payouts go directly to you or to your child.
Trust.
And then they come to you, and then you make the payments to the long-term care facility. And so that way, if there's additional funds, like let's say your monthly payout is 10,000 and your care is only 6,000, you're able to pocket that additional 4,000, as opposed to having it all go directly to the care home, and then the care home instead is holding on to that additional. So
That's a good tip.
yeah.
Well, it sounds like life insurance is obviously a complicated topic, but I think the answer is don't get overwhelmed by it. Just take one step, and something is better than nothing. You touched on those like smaller end of life policies at the end there. You see those advertised on TV, like when you're home watching game shows during the day, when you're sick on the couch or something, and it's very much targeted towards senior citizens that just want those little policies. Are those a good thing for those people, or should they just call a local insurance agent and get something better?
100% call a local insurance agent, because a lot of those are not real. A lot of them are scams and are very much targeting a vulnerable population.
That's what I thought.
So definitely call your agent.
Awesome. Good advice. Anything else you want to add on the life insurance front, Britt?
No, I think just touching on what you just said, even if you just get a $25,000 policy that will be very affordable for you, I just think that it's one of the best things that you can do for the people that you love, because the last thing that you want to happen is you pass away in a tragic accident, and not only is your family left grieving and unsure of what to do, but they're also left with a financial burden. And giving them that peace of mind will allow them to grieve in peace. And it can be, one of the last gifts that you're able to give them.
I think that's super good advice. And we kind of touched about this when we talked about estate planning, but when you take out that policy, who do you tell? Like, how the life insurance company's not going to track your family down and say, hey, this money is yours, right? How do you make sure that your loved ones can take advantage of that policy?
It's super important to put it in your will, just like we talked about last time. With your insurance policy, you can assign your beneficiary, and you can reassign that as many times as you want to. You can change it as often as possible. So I would say at least annually, biannually, make sure that the contact information for your beneficiary in there is up to date. But the most important piece is making sure that it is in your will, that your insurance company's contact information, policy number, all that jazz is in your will.
You can keep the documentation with your other estate planning documents. That's usually the best thing to do, is kind of have a centralized location for all of those important documents, the powers of attorney, the advance directive, the will or the trust, or both. Just making sure that they're all together, so your loved ones and your power people have access to those originals at the time that they need to be used.
Renee, you were talking about on a previous episode that when you do take out a mortgage, that sometimes those other companies will send you a solicitation to
For
get
mortgage life.
life insurance for your mortgage. If you want to just speak on why not to go with those and who those people are.
Sure. Yeah, we can touch on that again real quick. So usually when you buy a house, there's all these companies that go down and they go to the courthouse and they do a deed search, and they get a list of all the people that have recently got a home. And then they send you a solicitation that looks like it's coming from your mortgage company. It'll say, in regards to your Cornerstone Home Lending loan, but it's not actually from us. And it will offer you a life insurance policy that's called Mortgage Life. And it's different than the mortgage insurance you pay if you have less than 20% down. But what it does is it's a specific policy that only pays off your mortgage if something happens to you. And I'm not a fan of those at all. For one thing, I think a lot of them are more scammy and they're more expensive. But if something happened to my husband and there was a life insurance policy, would I rather have my mortgage paid off, or would I rather have the amount of money that my mortgage is sitting here that I have choice and control over? So if my mortgage is $600,000, do I just want a paid off house, or do I want $600,000 in cash? And I would take the $600,000 in cash all day long, because then I can pay other bills, I can live off of it, I can replace income, I can do whatever I want with that.
You can make the monthly mortgage payment.
Exactly. You can make a lot of mortgage payments with what that is.
And
So
still get the interest tax deduction.
Exactly. So the only time I would recommend something like that is if maybe you had already been turned down for all the other life insurance policies because of some health thing. I haven't seen that happen before. So I would definitely still reach out to a local reputable agent and find out what your options are, because chances are it's going to be cheaper and a better fit. Awesome. All right. Well, I think it's a good discussion. And I think, again, moral of the story, start somewhere, get something, and then tell somebody that you have it.
Preach. Thank you so much for joining us this week. Here's to empowering each other one story at a time.